Hi folks, welcome to the Better Dwelling YouTube channel. I'm Daniel Tencer, and boy is the Canadian housing market on fire. It's so hot I'm worried people are going to get burned. House prices are up 20 to 50% depending on the market you're in, but of course incomes are not up 20 to 50%, so where's the money coming from? Of course, it's coming from debt, more debt. The average mortgage in Canada now up to $335,000. And according to a recent report at TD Economics, Canadian mortgage borrowing has never been riskier. The TD economists took a look at data from the Bank of Canada's Financial System Review, and the Bank of Canada has this measure of what is a risky mortgage, what is a high-risk mortgage, and it's basically a mortgage that's 450% or more of your annual household income. So if you take out a mortgage that's more than 4.5 times what you make in a year, you have, according to the Bank of Canada, a high-risk mortgage. Now, what the TD economists found is that the share of mortgages that are these high-risk 450 plus mortgages hit the highest level ever at the end of last year. At the end of 2020, 22% of all mortgages were in this 450 plus category. That's up from around 16% before the pandemic, and frankly, I think that was high enough. Now, not everyone agrees with this measure of risk. Some people say, look, it doesn't really make much sense to compare the total debt to someone's annual income because it's the monthly payments that income has to support. And those monthly payments are determined by the amount of debt, the length of the mortgage, and by mortgage rates. And of course, mortgage rates are at an all-time low, so payments on those mortgages are very low relative to the total amount. So it's not that bad, they say. And yeah, I'll agree with that to an extent. But the total amount you borrow does matter. If you have a very high level of debt, you are going to be vulnerable to economic downturns. You're going to have a hard time. You're going to have a harder time than other people making it through the loss of a job or other shocks to the financial system. So it's not really a good idea, even if the payments are low, to take on excessively large amounts of cash. A recent report from CMHC, the Canada Mortgage and Housing Corporation, found that 65% of people who borrowed mortgages recently maxed out what they could borrow. Now think about these things together. People are maxing out what they can borrow at the lowest ever mortgage rates. That's, it's like starting out with a balloon that it's already really, really full, and then hoping that nothing comes along to make it fuller. It's a risky proposition. Now, another thing that critics of this criticism say is that, look, we have a mortgage stress test in Canada. You don't qualify for your mortgage at the rate that the lender is offering you. You have to qualify at 2 percentage points above that, or 5.25%, whichever is greater. So right now most people would be qualifying at 5.25%. So that's a kind of a buffer, a sort of a shield to make sure that people can really actually afford these mortgages, even if rates go up. Now, I'm not sure about that. I did some quick calculations on this. On that $335,000 average Canadian mortgage, if you got that mortgage at current mortgage rates around 1.8%, and your rate went up to 5.25 to the mortgage stress test level, you would have over $500 extra in payments per month after you renew. if you get an average sized mortgage in Toronto today, you'll have about 750 extra dollars per month in payments if that rise in interest rates happen. And in Vancouver, it's around 790. So, do you have $500 to $800 extra per month to put into your mortgage? If not, you might be in trouble if mortgage rates rise to the stress test level. One thing I want to stress about this is the people rushing out today to get mortgages are acting rationally. Right now, mortgage rates are lower than inflation. Inflation in Canada, headline inflation, is running at 3.6% according to the most recent numbers from StatsCan, and mortgage rates are around 1.8. That's a real inflation-adjusted mortgage rate of minus 1.8%. Who wouldn't want to borrow money at minus 1.8%? If you can lock that rate in today, that just makes sense. I mean, we're talking about the largest purchase you're likely to ever make, a commitment of 5 years, sometimes more, to these monthly payments. You're going to want the best deal you can possibly get. That makes sense. It's the Bank of Canada's actions that I kind of question in all of this. Last year, at the beginning of the pandemic, when we had that mini brief stock market crash, the Bank of Canada pulled out all the stops, started a quantitative easing program to buy debt out of the markets and replace it with cash. They did that with mortgages too. They had a mortgage purchase program. They bought billions and billions of dollars of mortgages, replaced those mortgages with cash at the lenders. This flood of cash, this huge supply of mortgage money brought down mortgage rates, and that's why we have these super low mortgage rates. Now, the thing about this is that the Bank of Canada is actually preventing the market's natural self-correcting mechanisms from functioning. If we had a normal housing market in a normal financial system, and you suddenly had this rush of people running out to borrow mortgages, what would happen is the lenders would be under pressure to find the money for all of this. They'd have to go out and borrow it. Their borrowing costs would go up. They would pass on those borrowing costs to consumers in the form of higher mortgage rates. Those higher mortgage rates would kind of cool down the enthusiasm. They would sort of bring down that rush of mortgage borrowers, and the housing market would cool off. But that can't happen if the central bank is artificially maintaining very low mortgage rates, very low interest rates throughout the economy, no matter how many people are trying to borrow. So let me finish with this thought. Don't trust the lenders and the regulators to know how much you can safely borrow. They just have these rules of thumb they use for determining it. People's situations are different. You need to really judge these things for yourself. Don't take on more debt than you know you can handle, even if someone is willing to lend it to you. Even if it means you don't get the house you want, because it's better to get a house that's slightly less than the one you want than to get the house you want and then lose it later. All right, thanks very much for listening. If you like this video, please hit the subscribe button below, because we will have more videos coming in the weeks to come. And if you think other people should see this video, then please hit the like button so that YouTube makes it more visible. Thanks. See you next time. Bye-bye.